Hello and welcome to the latest edition of the Stifel Strategist. My name is Kevin Cavan. Today we're going to be discussing 20-year MBS, which have been one of the more popular products in the MBS market over the past few months. Well, one of the frequently used metrics to assess the fair value price of 20-year MBS is to determine its proximity within the prices of 30-year and 15-year MBS of the same coupon, commonly referred to as the 15-year less 30-year price swap. Well, historically, new issue 20-year MBS traded about 50% of the 15-year, 30-year price swap for a given coupon. Well, 20-year has some unique characteristics compared to 30-year and 15-year. 20-year MBS are only 5 years longer in final maturity than 15-year MBS. However, 20-year MBS are only deliverable into a 30-year TBA bid, so offsetting circumstances there. In order to demonstrate the price relationship of 20-year versus 15 to 30, we display the prices of the 2% coupon for 15-year, 20-year, and 30-year in the table on this chart. Currently, the price difference between 15-year and 30-year twos is 72 ticks. Well, the recent offering of 20-year twos is up 36 ticks versus 30-year 2 TBA, and that's exactly 50% of the 15-year, 30-year price swap for 2% coupon. So investors may look at this price relationship and come to the conclusion that 20-year twos are fairly valued. However, we believe that's a rudimentary relative value assessment convention. We prefer a more robust assessment of the reward per unit of risk profile by calculating all of the metrics. Well, one of the challenges of evaluating 20-year MBS is to determine projected speeds for 20-year MBS. And in order to do that, you have to assess its refinanceability versus the 20-year primary rate. And it's difficult to find what the 20-year primary rate is. There are good indicators for primary rates of 30-year and 15-year that you can find on Bloomberg, but not so much 20-year. So what we did, looking at historical issuance trends of new origination collateral, what we determined is that the WACC of 20-year MBS tends to be about 70% of the difference between the WACCs of 30-year and 15-year. So using this formula, we can estimate what the 20-year primary rate is. That's what we've done in this chart. If we consider what the WACC of new issue collateral is we can determine the refinanceability and appropriate prepayment speeds for 30-year twos, 20-year twos, and 15-year twos. So given the WACC of 30-year twos, 279, we can determine that 30-year twos are out of the money versus the current 30-year primary rate of 308. Well, 20-year twos have a WACC of 268, and that is also out of the money versus the current estimated 20-year primary rate of 292 using our formula. Well, 15-year twos have a WACC of 249, and that is slightly in the money compared to the current 15-year primary rate of 240. So slightly faster speeds in 15-year twos, relatively slow or moderate speeds for 20-year twos and 30-year twos. So when we put this in the atom smasher, which we call yield book, and we compare the risk reward profile of 20-year twos versus a 50-50 combo of 30-year twos and 15-year twos, what we see is the 20-year pass-through picks 14 basis points in spread, 7 basis points of yield, 11 basis points of total return in the base case, 10 basis points of LIBOR OAS, 0.56 an effective convexity, and of course, effective duration is about the same. We're not making outright bets on the direction of interest rates. So we think this is a really good relative value comparison. And then when we project the performance of this trade across down rates and up rate scenarios, the trade favors the 20-year 2 pass-through in virtually every scenario. So this is a very good-looking trade here favoring the 20-year 2. Well, one of the reasons that 20-year 2s may have drifted toward the cheaper end of the 20-year basis range is the fact that the Fed doesn't buy 20-year 2s. If we look and see how much of 30-year 2s and 15-year 2s the Fed has taken out of circulation by virtue of their QE4 MBS purchase program, we see that the Fed currently owns 37% of all 30-year 2s and 40% of all 15-year 2s. It has artificially inflated the price and compressed the spreads of both 30-year 2s and 15-year 2s. It does not buy 20-year 2s, so you're not competing directly with the Fed when you come to the market and buy 20-year 2s. And that's one of the reasons why 20-year 2s have drifted toward the cheaper end of the range. So we encourage you to take advantage of this price dislocation and the favorable reward per unit of risk profile of 20-year 2s.